Now, these are from the Financial Times today. That was by Miles Johnson, the hedge fund correspondent for the Financial Times. Tracy Alloway and Vivian Rodriguez in New York are writing in the Financial Times 95 consecutive weeks of inflows to U.S. funds that invest in leveraged loans made by banks. Okay, now here's the thing. You may invest, banks make money on loans, and they make a lot of money on leveraged loans. A leveraged loan is not just the loan, but it's loans on loans and bets on loans and all. So anyway. And you can buy, these are exchange-traded funds, these ETFs. You can buy basically a fund which is a collection of these leveraged loans by these banks. One of the ones that they talk about is the PowerShares Senior Loan Portfolio. It's gone up to $7.4 billion worth of assets in the space of 3 years. It's an exchange-traded fund. But here's where it gets spooky. This is, those of you who've been listening to this program for a long time will remember in the fall, as I recall, it might have been the spring. It was either the first or third quarter of 2007. And there was an article in the Financial Times about how the housing starts in the United States had dropped a little over 30, as I recall, 34%. And I came on the air and just, read this small story like I'm reading this small story to you right now. And I said, the last time this happened was 1927. Late 1927, housing starts in the United States started falling. They continued to fall through 28, and it led right to the stock market crash of 29. Now, back then, information traveled a lot more slowly. And so in 2007, I said, I think it might be a good time, if one were in the stock market, to get out of it. In fact, to get out of pretty much everything. Now, I'm not an investment advisor, and I'm not offering investment advice. I'm just saying. Let me read you the first two sentences of this article in today's Financial Times. 95 consecutive weeks of inflows to U.S. funds that invest in leveraged loans made by banks came to an abrupt halt in the second week of April when investors pulled $249 million from the market. Since then, investors have continued to withdraw money from the funds, taking out $664 million just last week, according to Lipper data. Now the worry is that these funds may not be able to handle billions of dollars worth of outflows without depressing loan prices and disrupting the wider market. Now, in 2007, the bubble that we had was the housing bubble, the phony baloney mortgage bubble. Right now, the bubble that we have is a credit bubble. We've had Stephanie Kelton. We've had a number of the economists on this program talking about there's over $50 trillion in private debt. The problem is not the government debt. Government debt, no big deal. The problem is private debt. And the fact that banks now are securitizing private debt in ways that make what they were doing with mortgages look creative. Mortgages are arguably a form of private debt, but this goes way beyond that. So we went through the dot-com bubble. So this is what happens when the top tax rate goes below 50%, is you get bubbles and busts. So we went through the tech bubble, the dot-com bubble during the Clinton administration, and then that crashed. And then we went through the housing bubble in the Bush administration, and then that crashed. And for the last 5 years, we've been in a credit bubble. And what has been happening is you've even seen companies, because interest rates are so low, companies are stashing hundreds of billions of dollars offshore and then borrowing domestically to fund their operations.
You're listening to the Thom Hartmann Program. Call 866-987-THOM.
The net of all this is that it wouldn't surprise me if the crash of 2016 I was predicting in the title of my book of the same title were to happen before November of 2014.